Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where today I'm excited to chat with Michael Testorf, who's Portfolio Manager on the Global Growth Equity Investment Team at ClearBridge Investments based in New York. Michael and the team co-manage the Global Equity Growth Strategy for ClearBridge. Michael joined ClearBridge Investments in 2015 and has 37 years of industry experience under his belt. Welcome, Michael.
Thanks, James, for having me and introducing the strategy.
It's an exciting year for ClearBridge in Australia with the launch of the ClearBridge Global Growth Fund in this market. Michael, can you take us through the investment objectives of the fund and how you feel that aligns with the evolving needs of the Australian investor marketplace?
Sure, with pleasure. So what we have seen over the last years with COVID and the aftermath of COVID, there was a hell lot of volatility over the time, and that created quite some headwinds for many of the growth managers. So what I do believe is that our strategy and our investment objective, which is delivering outperformance at market-like volatility, would be a good fit to navigate through these kind of choppy waters which we had over the last years. Now, if you were looking at how do we do that and how do we think about markets overall, we are a believer in efficient markets over a longer term, but shorter term, we try to take advantage of misunderstood growth opportunities in the market where we differ somewhere, somehow, and that is normally either in duration or in magnitude of growth. So when we look at the overall portfolio, the output of that would be roughly 80 names, 60 to 100 to be precise, but we're pretty much in the middle at 80. These are companies which have a very strong quality focus. They have durable advantage with good management and good cash flow generation. And that should be helpful actually for the overall performance of the portfolio. Now, because of our broader view of growth versus other managers, we probably will not end up as the number one fund in one particular year. But by grinding every single year, one year after the other, we have delivered very strong, consistent outperformance over the years. So it's basically a product which investors could hold for a longer period of time.
What are the key hallmarks of the strategy and the process?
Sure. I mean, I know Australia is a very competitive market for global growth managers, and the question is, what does set us apart from other managers? And I think there would be two, potentially three parts which I would like you to know about. One is we use our proprietary developed front-end quant model, which helps us to screen the big universe which we have to go through. That helps us in the screening process, but also in the monitoring of existing holdings in the portfolio. Now, the quant model is comprised out of 50% roughly value and quality factors and 50% of gross earnings and price momentum factors. We have back-tested the model before implementing it to our global growth strategy with a very strong performance over that period. We haven't changed it since then, and it helped us to create a process which is objective and repeatable. And that is very critical for managers overall, for the longevity of fund managers. So that would be number one. Number two is, in order to have this strategy, as I mentioned earlier, being useful for investors over different periods in the equity markets, we have introduced a broader definition of growth. We have introduced three buckets of growth. One is, which most of the growth manager will embrace, is our companies which we call emerging growth. We allocate up to 30% into that bucket. And these are companies which are early in their life cycle. These are companies which have very strong growth, often no cash flow, actually cash burning, and very large addressable markets. Risk with these companies, though, is some of them might not make it, some of them would be very, very strong. But how we try to get to our risk-adjusted returns is by limiting the exposure, meaning we put potentially only up to 1% in these kind of companies, and we have multiple of these. What makes us different with these companies versus the overall market very often is the magnitude of growth, where we see more growth opportunities for these companies than the market does. The second bucket, which is I call it always the bread and butter business of ours, is the secular growth bucket, 40 to 60% of allocation. Companies are a little bit further in their life cycle. They have already very established good management, they do have strong cash flows, and they're compounding returns year by year. Beauty about that bucket is it delivers less volatility, because these are companies which are just, as I said, compounding, grinding further, and less earnings volatility means also most likely less volatility in stock market prices. So it gives us the stability factor within the portfolio. And number three is what I mentioned is the wider definition, where we have, which we call structural bucket. These could be companies which are already very mature, could be 20 to 40% of the portfolio. And these companies could be very often in value-like sectors, like whatever, financials or utilities, materials, and some others. But what we are looking for are companies which have a strong earnings and cash flow uplift. These are company specific or industry specific. And here we could see it could be magnitude or duration, which is mispriced in the market. Normally, these companies also don't stay as long as others in our portfolios. So these are the two major things. And of course, I just want to mention, I mean, our team, which is around for many years already, with a very strong analyst bench, mainly in New York, has helped us to continue to identify these opportunities.
Can you discuss how the fund integrates ESG considerations into its decision making, and what impact that can have on investment outcomes?
Yeah, I mean, ClearBridge has introduced ESG to all our portfolios already in 1987. It's a long time ago, in particular when you look at US fund managers. I think we were one of the very, very early ones having implemented ESG overall. And we're a believer in value creation through ESG. And perhaps I give you a little bit of an idea how it works at our firm. I mean, a lot of others do use third-party research or have a dedicated ESG department working somewhat together with the fundamental research team. We think the best value and value creation is coming through putting these businesses or putting this together, where the fundamental analyst is also the one rating the company on ESG. And value creation from ESG can be coming from multiple factors. I mean, I just want to mention a very, very few and simple ones, to be honest, and easy to understand is, if you look at E, for example, the environmental part. So by being a little bit more careful about use of resources, energy, waste, water, and so on, there might be a little bit of an upfront investment, but over a short period of time, you have amortized this investment, and you will create better cost management, better margins, and that will create value. And the fundamental analyst can put that into their spreadsheets. On the human side, on the social side, human resources are incredibly important these days. Why? Because we have very tight labor markets. We would like to have a very good high employee retention. And how do we get it? By making employees more happy at the firm. You want to be a good employer. And what happens normally? You have higher efficiency of these workers and less employee turnover. That, of course, will also be reflected in margins and profitability. And the most important for me actually is very often governance. And governance or better governance companies have normally lower risk. Lower risk lead to lower cost of capital to higher profitability again. Particularly important is the governance aspect. because governance or good governance means that you do have lower risk. Lower risk means lower cost of capital, lower cost of capital, higher profitability. That's the thought process of the whole thing. Important there is independent boards. It's a good disclosure in particular, and that's where I look in particular at.
Michael, it sounds like you'd be quite heavily involved in engaging with companies on their ESG issues and any queries that you might have. So could you give us an example maybe of how engagement with a company has influenced an investment decision and the actual management of the portfolio?
Sure. What we do on a regular basis, we do engage with all of the companies which we hold in our portfolio and potential companies which we would like to include. And that is talking to management themselves and talking to the ESG departments of the respective companies. And we like also to talk to management because for one particular reason, the ESG department will give us a right spin for sure. But we want to see also if management embraces the ESG principles which were laid out. So that is one, and we are also active proxy voters and have a very clear opinion if we vote in favor or not with management, and that is on a regular basis. So in the past, we did have companies where we had violation of our ESG principles. And very often, as I mentioned earlier, it happened on disclosure or some of the governance. And we had just recently a company in France which was bidding for public tenders and were bribing officials. And that is a clear miss of oversight of that particular company. Share price has fallen heavily. We were early selling the company. And we would be in wait and see if the company will improve on this kind of oversight and improve governance. Governance also is important for me in emerging markets in particular, because very often we have companies which are partly state-owned, and shareholders like us are not seen as equal partners. And companies or governments very often use the proceeds and the profits of a company in order to get more tax income, gets a higher employment, and so on, and so on, and so on. And even if it's not a government-owned company, very often we have founders in emerging markets which do not respect shareholders. And that's where there's a little bit of a problem for us as shareholders, and we try to abstain with these kind of companies.
Concentration is a major issue in the stock markets in general, and particularly in the growth area. And the ClearBridge Global Growth Fund does have in the top 5 holdings Microsoft, Apple, Amazon, Alphabet. How does the fund ensure adequate diversification while obviously wanting to maintain positions in those great growth situations that are key portfolio holdings?
Yeah. That's a very fair question. And to be honest, I mean, we had all of the Magnificent Seven at one point in time. We have sold one of them already, which is Tesla, and we have reduced some others. But there are also other ways of playing the same drivers which made the Magnificent Seven very, very strong. I mean, the biggest drivers for them, in particular, are the data centers and the move into AI. But there are companies which are exposed to the same, like particular on the semiconductor side, where we have long-term holdings already in TSMC and ASML, which are providing actually the chips and the production mechanism to produce these kind of chips. So I think there are ways to diversify with the same drivers. But also have in mind, I mean, the Magnificent Seven, as magnificent as they were, that's honestly true for 2023, where they were growing over 30% EPS, and the rest of the market, the S&P 493, I call it now, is down 4%. In 2024, the gap is shrinking, and the gap most likely will shrink further in 25, and we will see the rest of the S&P 500, meaning the 493s, closing the gap, and potentially, if we have a broadening of or market breadth, then we could see that even small caps will outperform at one point in time.
And Michael, what economic indicators or potential events are you and the team really watching closely over the rest of 2024?
For me, interest rates and the decision of the central banks will be the most decisive factor which we will see. I mean, without any doubt, because it was a big swing factor already in 24 where we expected multiple rate cuts. Now we have, what do we have now? One rate cut or something like that? I see rate cuts potentially happening in Europe this summer already, and in Japan we have left negative interest rate for now, and interest rates might move up a little bit more. But I think it's very important to think about it in the portfolio context, where we have overall, as I mentioned earlier, is that we have very high cash flow generative companies. They are not necessarily depending on outside financing. Of course, interest rates play a role because they do optimize the balance sheet without any doubt, and cost of interest rates play a role and have an impact of earnings. But overall, because of high cash flow generation, it's not the major point which makes or breaks them. I think this is one thing to have in mind when we talk about interest rates. Secondly, I do think that most of the companies have done actually a relatively good job in extending their debt profile. The consumer has done in the United States in particular because they have long-term mortgages. They have 15 to 30-year mortgages, have locked it in at 3 point something. If they had to refinance today, and only the ones who are changing houses have to do so, and then they pay 7.5 or 8 even. And the companies have done that normally for 5 to 7 years, and are enjoying low interest rates, and the rollover is only gradual. So from that perspective, it's good. We will see a lot of elections all over the world. The US election probably the most important. I will not necessarily give an outcome on it, but the most likely scenario is we have a little bit more of the same, because most likely Senate and House will be split. And then we will have changes at the margin. With the Trump government, of course, we will see most likely more tariffs. When we come closer to the time, we will potentially make one or the other change given these tariff scenario.
Michael, given the magnitude of the potential impacts of the US election, are you expecting heightened volatility as we move more towards November and the end of the year?
I think this is a fair statement, that we will see more volatility. But again, with our approach and the broader definition of growth, we have opportunities to take advantage of this kind of volatility. You know, think about it. If something is which we really like, a company which we really like, get even more mispriced in the market, it's an opportunity for us to pick up one or the other stock. And I think that's a critical thing to understand with our overall approach. Falling prices or whatever, or volatility, is not necessarily a bad thing.
Michael Testorf, ClearBridge Investments, it's been a pleasure going in depth with you.
Thank you so much for having me.
Our pleasure.